This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today on the show, I have Alex Greyserman. He holds the position of Chief Scientist at ISAM, a specialist managed futures fund manager. 25 years of experience in the hedge fund industry. Alex initially began working with Mint Investment Management, the first managed futures advisor to manage more than $1 billion. Mint, started by Larry Hite. Larry Hite of Market Wizards fame. Larry Hite, somebody I consider a friend, a mentor, somebody who has taught me a lot. Great conversation with Alex today. And please check out his new book, Trend Following with Managed Futures. It is the definitive academic treatise on trend following. Alex brings some great color today. I hope you enjoy this conversation.
Are you still in God knows where country?
Oh, I love it. I love it. You know what? Let's just leave it like that. I think that keeps the audience guessing God knows where country. We'll circle back on the back end, maybe if we got some extra time and talk about that. Hey, let me jump right into the heart of the matter. When I had you and Larry on in the spring, I think we were right in the middle of the weekly parade of 26-year-old Financial Times reporters writing about trend following is dead. And then something funny happened along the way to the parade this summer. Even in a zero interest rate environment, in a relatively low volatility environment, all of a sudden you and your peers have started to make quite a bit of trend following money. And I know we don't want this to sound like an infomercial, but I think it's educational in the sense that a lot of people probably don't know that when you see all these epitaphs and obituaries written about trend following, well, it just hasn't worked out that way, has it, Alex?
You know, I've been around long enough to probably seen 4 or 5 of these obituaries written, maybe even more over the years, and we're still here. Last 3-4 months, things in trend following space are pretty good, but this is the nature. I mean, we've seen this in our 800-year study, right? This is not some voodoo sort of arbitrage strategy that extracts something from somewhere that, you know, that's not understood, where it could just easily end. This is a strategy that harvests natural occurrings in markets. And, you know, the only way you can, I guess, permanently kill a trend following strategy is to declare all markets to go sideways forever, or to declare that no market will ever move significantly away from some sort of equilibrium, and it just doesn't happen for long enough periods of time. You know, and things move more than, as I'm sitting here, I'm looking at the yield of the 10-year note, and, you know, all prognosticators would have said that, oh, that can't go to where it is now, and here it is. But that's the nature of trend following.
Yeah, look at something like crude oil. I mean, there's been all kinds of fundamental opinions about why oil has to go up or why it's at the right price and this and that. And then, wham, bam, thank you, ma'am. The price is dropping pretty significantly, isn't it?
Yeah, nobody knows where it's going to go, but it's just in nature of people to figure, okay, things are just not going to move far away from where they are. Yet the same people will invest most of their money in stocks and hope that they'll go up 100%. You know, this is why this kind of strategy adds value over time. For example, I mean, we're sitting here now, October 14th, just in recent days, the equity markets have made, you know, not major collapses, but material downturn, and, you know, things are okay in the trend following space. You know, we're actually making money. So that's, at the end of the day, the value of this kind of strategy.
And I think it's important for people to realize you're not saying that you know what's going to happen tomorrow. You're not saying that stocks are going to continue to go down. But I think what we're going to try and point out in this conversation is there's another way to think except being only long stocks. There's something else out there. And you've been in the middle of that something else for a long time. And before we break apart some of the bigger picture issues in your new book, Trend Following with Managed Futures, I would love for you to go back in time a little bit. And I know you're not a big fan of any kind of personal stories and stuff like that. I know your personality a little, kind of just a facts guy, and I love that. And your book definitely puts that forth out there. But, you work with one of the most colorful people that I've ever met. I would love for you to talk about your first meeting, how old you were, your background, and your first meeting with Larry Hite and how you guys have come to have this great career together. It's really a fun story. And then we'll get into the book and get into some of the meatier issues. But I think the audience would love to hear that story.
Yeah, it was kind of a fork in the road that, as I look back, the joke, if you get to a fork in the road, you take it. I came to interview with Larry in 1989. I was just a kid out of school. I didn't know anything about trend following or certainly not managed futures or details. I just needed a job. I think I was making $28,000 a year, and Larry offered me $32,000. I still have the offer sheet.
Hold on. You say just out of school. Were you 22, 26, grad school, undergrad?
21, 22.
Okay, young guy.
Yeah. Didn't really know Larry Hite was, but this was in Millburn, New Jersey, and he was one of the guys that interviewed me. That the really interesting thing is that the Market Wizards book had either just come out or was coming out. I don't recall whether there was the actual book on the shelf or a draft of the book on the shelf, but somebody gave me in the office the chapter about Larry to read while I was kind of like waiting. And I remember just flipping to, I'm paraphrasing Jack Schwager's question, something like, what's your edge? Or something like that. And as somewhat of a scientist out of school, I would normally have expected some quite scientific answer, because I kind of heard that meant that something quantitative. So some sort of rocket science answer for what people did in 1989. But then I read this psychology stuff about how we know what we don't know. And I was like, you got to be kidding me. What am I doing here?
That was a line from Larry.
Yeah, Larry said that his edge is he knows what he doesn't know.
And you're reading this before you go into the interview.
Yeah, I'm reading this before I'm going into the interview. Interview was kind of like, okay, whatever, go home. But then, like typically you have to follow up and write a letter or an email. It was a great interview, or tell the headhunter that I really want this job. And I couldn't figure out whether I really wanted to tell him that I really wanted this job, because actually I was confused. But, this is actually, now that I see now, no different than the initial confusion Larry gives. He gave a talk in my class at Columbia last week. I teach a class at Columbia. He gave a talk to a bunch of grad students, and he confused the hell out of them too. Because it takes time to sink in.
He makes those simple statements, but the depth of those simple statements is not to be underestimated.
Yeah, it's, later on I've obviously learned what all that means. It's the respect for risk and not getting very emotionally attached to any one strategy and those kind of things, which allow you to survive for decades and decades in the markets. But initially, just like last week in my class, I have 80, 90 graduate school PhD students, and here comes the market wizard, and they start asking him things that they think a market wizard should know, like where gold is going next week or which way the market is going, because he's some sort of a wizard. And he, of course, says he has no idea. He just needs to know what he doesn't know. And if he gets into a trade and if he's wrong, then he has to get out of it. But it is so powerful, but yet so simple. So to go back to my story, really, it's the fact that he offered me a couple $1,000s more that I ended up taking the job. But I really had no idea, no way to appreciate that, and no idea how to judge really meant or what Larry did. I just, I dove in. That's
How quickly did you know, once you were hired and you got into the office and you're around Larry, how quickly did you know this was going to possibly be your passion for the rest of your career? How quickly did you start to have that feeling?
I mean, it probably still took a couple of years. I mean, I saw the systems making money, but it took a couple of years to kind of sink in what this is about. I was like most probably geeks in the beginning and just trying to find the Holy Grail. But it's, your realization that no matter how smart you are, I mean, I see this with all my students, I joke that I try to bring their IQ down after they take my class rather than go up. Obviously, their IQ is high to begin with, but the kind of investment IQ, if you think you know everything, you'll just end up failing. So it took a while to establish kind of like the right mental equilibrium. This is, by the way, where it's hard to hire the right people in this kind of area, because you need a combination of two things that almost never go together, which is very, very smart people that are also very, very humble. And so you have to survive in this business. I think you need to have the right balance. If you get too smart and not humble enough, you get too emotionally attached. There's lots of people out there in the world who are very humble, but maybe not smart enough to do, at least the basic arithmetic of the strategies. So, I mean, it took me actually a while to sink in, but I've been in this for 25 years. I learned not to get too emotionally attached to, people declaring trend following dead and any of those kinds of things. But, on the other hand, not to feel like we're walking on water when we're up 30% on the year. These things come and go, but over time it works. But I wanted to make one point about trend following that I think is confusing to people. They focus too much on, the S&P or that market, obviously, because it's in everybody's portfolios. But they think, okay, the value of trend following is just kind of like to time the short side of the S&P or get them out of the long only. I have a lot of allocators who are asking me, well, what's my position in the S&P? And if I say I'm long because trend following is long, then they say, oh, but that's not a diversifying investment. Why do I need trend following? And if I say I'm short, then they say, okay, maybe that's too late. And they try to overthink this. The value of trend following is not just getting the right side of the S&P trade. It may or may not happen. The truth is that the systems are not that great in any one market. The value of trend following is that we can do this over 150 markets or however many markets one can find and really have a diversified, uncorrelated investment. I mean, that's what this is about. That's why it's worked, in our book for 800 years. If you look back at my first experience with equity market kind of shocks, it was in 1987. Mint made 60% in that year. This was, before I started at Mint, so this is in history books. But didn't make that from necessarily timing was it Black Monday, October, or was it 19th or something crash? It made its money in some corn trades and other things and other markets, and same thing in 01, 02, same thing in 2008. The value of trend following, it's not a one market thing. It's a harvesting of natural human behavior in 150 different markets.
Alex, let me interject there. I think there's been, and I'm curious your opinion on this, there's been quite a few, you see papers about trend following, the classical CTA diversified across markets like you're talking about. I think also in the last bunch of years, there's been a lot of papers about momentum, and they specifically focus only on equities. So I think there's some confusion comes from some of the academic work where it's been attempting to attach momentum only to an equity perspective and ignoring what you're talking about as this great diversification.
Yeah, so maybe this is a slightly nerdy for the audience, but there is a difference between so-called cross-sectional momentum, which is almost what all academic papers hit when the equities. This would be some kind of relative one stock to another, and more of the time series kind of momentum, which is what trend following is. We just trend follow any given market, whether it's going up and down, really unrelated to other markets. It's related in terms of the correlation and how much you risk, but not in terms of the signal. We can have no position in all markets except for one. All these equity papers are dealing with this cross-sectional momentum where you compare one stock to another and things like that, and they get into the efficient markets and whether it should exist or doesn't exist. It's just overcomplicating things. When we have 800 years of data and not simple strategies, but simple concepts. You buy high and you sell higher, and you short when it's going down and you cover lower. That works. In fact, one of the academic papers out there by one of our competitors actually calls it time series momentum. That's what this is. By the way, anything in equities is invariably probably going to correlate to equities, even if you try to make it uncorrelated to equities. What adds value is trend following, whether it's bonds or commodities or emissions or iron ore or obviously currencies, all these other markets. And then people ask me, well, what about the interventions and the government this and the government that? And meanwhile, look where the bond yields are and how far they've gone. Things can go quite far.
The subtitle of your book, the phrase crisis alpha, is in the subtitle. So it's clear that anybody that looks at the data, that during these crises periods, that the type of trend following that we're talking about, this time series, does perform exceptionally well. There's no guarantee that things will work out that way, but it's performed that way. But what's interesting about this summer, the last bunch of months, we really weren't at a crisis period, but there still was trend following performance coming out, as I mentioned at the beginning of this podcast, from kind of a fairly low volatility, zero interest rate environment. So it's not, if somebody was to couch trend following as only crisis alpha, that would be a mistake, would it not be?
Yes. In fact, some people in our space have tried to make some kind of an excuse for some lackluster performance by calling this a tail hedge and saying, well, there was no tail. That's a total mistake. Trend following has, two great features that you probably can't find in almost any other investment. First, it's totally uncorrelated. So if you start with that, you look at the history of trend following for 10 years, 20 years, 800 years, it generates a return stream with zero to slightly negative correlation to all other asset classes. So if we take that as given, that's just, when you have 800 years of data, I mean, it's pretty close to given. It's a totally uncorrelated. It also happens to be quite negatively correlated in many periods when you want the negative correlation, which is the crisis periods, because it tends to make money from whether it's inflation shocks or downturns in equities or something else going on somewhere. Typically volatility picks up during those periods and it makes money somewhere. But it's not only that. You could take out all the crisis alpha periods or all the crisis periods, and it's still a great investment. I'd argue it's a liquid investment because we trade liquid markets. And so, people will go in their 401k plan and have 5,000 versions of the same thing, right? Small cap, mid cap, SMID cap. I heard this term recently, SMID cap, small to mid cap, or, large cap and international and this and that. And I mean, how many versions are there of being long only, which are all, call it 80, 90% correlated, 70% correlated at least? Of course, you get a little diversification from that, so fair enough. But imagine in that same 401k plan or whatever list of instruments, now there was something, called XYZ. It wasn't labeled trend following, and somebody remembers, oh, I read something bad about trend following. It's just another investment, another mutual fund or another fund that somebody can put their money into. And you look at it and say, wow, this thing is just different. And it tends to work when other things don't. Well, how much closer do you get to a holy grail? I don't, maybe that's too strong of a statement, but in terms of the possibilities of what one can invest in, how much better can it be? It's totally diversifying, and there's a good chance, no guarantee, but there's a good chance that it'll perform in the periods when other things don't. So, you go back to optimization 101, any kind of optimization of the portfolio should tell you to have some allocation to that thing. In fact, we're writing a paper right now on the topic of how costly is it to not have trend following in your portfolio. You know, how much do you give up by actually not having it? Not in any particular year, but over time. And it's quite costly because you're actually avoiding a tremendously diversifying asset class.
Alex, let me jump into the idea of benchmarking, and specifically those institutional managers out there that really are fixated on stocks, and they look at the world through the prism of stocks, the long-only prism. And your firm has to deal with that. It's a constant education process. And if you look at a situation like CalPERS, they had a very small percentage, relatively speaking, with perhaps managers like ISAM. I'm not sure if they had it. I'm not saying that I don't know if they had an investment with ISAM or not, but I'm just saying in general, trend following. And it might have even been too small to even make a difference. How in the world, I mean, that's not the best way to say it, but how can a firm like your firm, how someone like me is trying to spread these messages to get these institutional players that control so many assets in the long-only space, and they're only worried about their career risk, frankly, to make the smart decision, to make the wise decision. I wonder if you could maybe relay a story or how you talk to people, watching people convert or watching people not convert to this way of thinking. I know it's kind of a big question, but I'm sure you see where I'm going.
Yeah, I mean, we do this all day long. And some people, I mean, we have major pension fund investors, so some people get it. It's interesting that in some parts of the world, you know, maybe it's Australia, Canada, you know, Middle East. I'm just kind of maybe part of the world that you're in, Japan kind of area, historically have been kind of diversification friendly. It's almost like sort of a mental mindset, maybe because, well, the Japanese market certainly hasn't been going up in a straight line, right? Mm. They have a lot of currency kind of movements, and those parts of the world are just friendly to the concept of diversification, right? Trend following will follow from there, but you first have to have the concept of moving somebody away from 100% equities, right? The U.S. is somehow just this, you know, emotionally attached to this idea that, you know, everything just will go up forever. Obviously, some institutions have allocations to this. The CalPERS thing, by the way, probably was not a managed futures issue. It was just the size of the hedge funds. They actually had a decent allocation to managed futures. But anyway, some institutions it really depends on their appetite for embracing diversification, and as you use the word benchmark, whether some form of diversification is in the benchmark. So, I mean, we look at this, you know, what's the benchmark of the institution? And if the benchmark doesn't allow for this kind of diversification, then we can talk to them till the cows come home. They probably won't risk their career by putting it in. Because at the end of the day, a 1% allocation to trend following is not going to make any difference. You know, it has to be 5, 10, you know, and we have institutions who have investments with us or with some of our peers at that level, but their investment committee has embraced that in terms of their benchmark, and they've just in general embraced the concept of diversification. To some people, it's like so obvious, like, well, I can't believe that we even considered not doing it. And to some people, it's just like, okay, stocks go up forever, so why do I need to bother?
I sometimes think that it would take a Japanese style stock market, perhaps, to really get some people to say we have to change. I think as long as there's going to be some people out there that as long as equities go up, seemingly in a straight line, even though there's been some 50% drawdowns the last 15 years, they're going to be hard to convince, aren't they?
Yeah, and, you know, U.S., I mean, the NASDAQ is in a, 15, 16, 17-year drawdown, but it's just this, especially in the U.S., like no matter what, it's just all about equities go straight up, equities go straight up, equities will go straight up. You know, I don't know if it'll take a Japanese type of downturn, but some sort of a shock in the system. But again, I don't I'm trying to tell people it's not that you just have to have that shock. Just imagine I call this, a regular mutual fund. Why not have a diversifying, uncorrelated investment in your portfolio that can do well when other things don't? You don't have to appeal to somebody's sense that, wow, this is only going to make money if you go down 100%. People try to overthink the environmental factors for trend following, and then they try to time them. Like some people just got into their heads that this only works when the volatility's high. Well, you said a minute ago that, the volatility hasn't been particularly high recently, and we've done well. There's no law that says a market cannot go, there's no law that says crude oil can't go from, 100 something down to, where is it now, 85 or something like that, in a fairly smooth line. You don't have to have massive volatility. There was a stomach virus affected lean hogs earlier this year and made prices go way up, and not particularly with tremendous volatility. It was just a fundamental event. This whole down movement in interest rates over the years hasn't been particularly highly volatile. So people think, somebody said to me, this strategy only works in high volatility environments, so I'll wait till there's a high volatility environment. Well, things are not that easy, right? By the time you get to a high volatility environment, or it doesn't work because, you have too much intervention. Well, wait a second. The intervention has caused the biggest trend of all time in fixed income.
So they want to trade your trend following strategy, huh? That they want to trade you.
Yeah, they want to trade me. People years ago used to want to time equity markets too. Remember that? People would try to time equity markets, get in and out, fund timing, all this. It's not that simple. It's not supposed to be that simple. What you're supposed to do is have a handful of diversifying investments, and, that's what's going to take your portfolio to the promised land, not trying to time. In fact, the worst thing you can do, I tell people that the worst thing you can do is to trend follower, right? To try to time it that when they're doing well, I should give them more money, and when they're doing poorly, I should take money away. That is actually the worst kind of investment you can make.
Let me shift gears on you again. I think you're fairly clear on your opinion there. The science of trend following. So we talk in the beginning of this conversation, you meeting Larry, you talk about being a teacher. You have many, many PhD candidate students at Columbia. So let's say hypothetically, so you're the top guy now, or one of the top guys now. So they come to the office. The new employee comes to the office. Obviously, in this day and age, they're going to know something about ISAM. They're going to know something about you. They're going to know something about Larry before they sit down with you. But you have to introduce the science of trend following to that new candidate, that new person that you want to join your team. How do you start? I know this can go on for a long time. There's no way we can even break apart your book, the density of your book. As I told Katie, I said, you guys have put down the academic treatise that I don't know who's going to attempt to compete with. But how do you introduce to that new person in your office the science of trend following? Science and investing. This has been a relatively new phenomena that people connect these words together.
In the book, we have all these things like adaptive markets hypothesis and behavioral theory and things like that. But at the end of the day, what I would tell people is that the markets are some sort of a risk transfer mechanism. You cannot assume that just because you're smart, you will suck money out of the markets, right? If you think of it like a poker game, it could be a zero-sum game. You could be the best player, but then your profits will come down, not because your skill goes down, but because the other people at the table will just leave the game. So is it a game of zero-sum kind of outsmarting people, or is it a natural phenomenon in the markets, almost kind of like providing insurance? Larry talks about this in our last talk about relating trend following to insurance. So I just say that, okay, there are natural occurring things in the markets. Let's start with something other than trend following. So we have an analogy: value investing, right? It's been scientifically, dare I say, proven or shown with data that value investing works because a lot of investors don't want to hold those stocks, when they go down, and you actually earn a economic rent type of risk premium if you hold them. There are other examples in the markets where you're actually providing value to the markets by doing a certain thing. That's what makes it lasting, right? Because there's no way for 800 years you could find some gimmick that makes money where you would only do that if nobody else knew about it. There's no way you can get away with that for 800 years, right? Somebody from my class will figure it out and it'll be gone. This happens a lot with some, high frequency and those things like that. So the science is, the natural element of it is that what we're actually doing, what trend following is actually doing, is providing liquidity to the hedgers, and it's creating an equilibrium in the markets, and we have to get paid for that. That's why this works for 800 years. If the price of oil, for example, is going up, right now it's going down, but if it's going up, airline companies will almost certainly need to sell oil to lock in a future price, right? They're not in the business of counter trending. They just need to sell it to lock in a future price. We at that point buy it. Maybe it gets us a little technical, but just it's conceptually establishing the fact that it's a natural occurring thing. The markets need players like us. Otherwise, you just have a whole bunch of hedgers that, just the markets won't exist.
You haven't used the word speculation. You're speculators.
Yeah, we're speculators. And then, actually we're talking in the book, there's hedger, speculator, risk transfer, and you need to have this. But it cannot be, if you think about kind of evolutionary things, it cannot be a free lunch. If I made money on every single trend following trade, the hedgers would stop hedging. Sometimes their hedge turns out to be a good idea. Sometimes they would have turned out better not to have hedged. Sometimes, I will look better if I bought oil, or I look better if I somehow ignored that trade. Of course, we take all trend following trades, but it's supposed to be slightly painful. But, in the end, if you look at the 800 years, the data shows that the equilibrium risk-adjusted returns are pretty good. They're slightly painful. That's why you can have a couple bad years, or you can have drawdowns. If it was too good, you would have every hedger hiring a quant from my class and run, moving average systems to time their hedges. But it's the equilibrium of the markets that establishes this principle, and that's what makes it work over 800 years. But trend following is almost unique in that area. I know you talked to Katie about divergent and convergent. A lot of convergent type strategies are very limited in their capacity, very limited in what they can do, because if 5 other people discover it, it could be gone. This is just a natural thing. You called it hedger speculator. So I think that's a good answer. That's how I start with, in fact, I just hired somebody from my class that started working with me. That's how we described it. It's a naturally occurring phenomenon in the markets. Then it's just a matter of a handful of different ways of actually capturing it. But it's there. It almost cannot go away. It can temporarily, on a mark-to-market basis, not work. But it just structurally cannot disappear. Otherwise, you might as well shut down the markets and go back to communism.
Well, hey, that's a great lead in to where I wanted to go. I have a few big picture trend following type questions left, but since you had told me, and I knew by your accent, you were born in the former Soviet Union. What country were you born in, Alex?
Well, actually, I don't know. No, it's I've had my passport changed several times. My U.S. passport originally used to say USSR, because I came to the U.S. when the USSR still existed. So technically, I was born in the former Soviet Union. But then they called me up and they said, okay, we need to change your passport because this new country got created called Ukraine. And now we have to reprint your passport, and now it says born in Ukraine. But now with what's going on there, right? I mean, they might call me tomorrow and say, okay, we have to reprint your passport. Now you were born in I don't know, Russia or something else.
Here's where I wanted to go with, though. Bringing it up, though, is not just for a kind of a silly reason or a flippant reason. So do you feel like, though, in your career, I don't know, what age did you come to America?
12.
12. Do you feel like you've had, I just relay a personal, nice achievement in your life, nice successful career. I think a lot of people would say, gosh, I wish I knew how to make those steps. Did you have an advantage coming from where you came? Was there a built-in drive or motivation that you think gave you an advantage over other peers that you might have seen in America once you got to America?
Well, I guess I know we probably don't have hours to speak about the immigrant drive, but right, that's the immigrant drive that got me to, I don't know, maybe going on interviews in an area that I had no clue about because I could maybe make more money. I mean, at that point, it was like sort of survival and making money kind of thing, not this grand idea I'm going to become a finance, person. So it's just the, bouncing around from washing dishes to Friendlies, which was my first job, to this and that, to pay for school. Certainly my parents didn't have money to really, pay for anything back then. So it's just like the inherent immigrant drive to keep pushing. I had a job before I went to interview for Larry, but, I wanted to do better. I don't know if there was any other advantage other than just keep pushing, keep driving, don't assume somebody's going to hand it to you. Larry, probably you've heard stories from him, he had a disadvantage, with not being able to see and those kinds of things. I had a small disadvantage in the beginning. I couldn't even speak English. So that's why I had a dishwashing job. Nobody had to tell me what to do. If there's a pile of dishes, then I had to wash them.
Meeting Larry was an opportunistic type thing because let's face it. I know from when I first met Larry, he gave me so much of his time and energy, and we met so many times. And I just feel like, Larry's the type of guy that if he sees somebody trying and really pushing, Larry's the kind of guy that reaches down and says, okay, I'll give you my time. If you're really hungry, I'll give you my time. And, I feel very fortunate to have met Larry. Have not spent as much time around him as you, of course, but still, it's changed my life to meet people like Larry.
I started at Mint not as some kind of a massive. I started as a technical guy doing some Sybase programming. I was kind of like quite a low level person. Could have stayed as a technologist for any number of years, but again, it's that drive to see what else. I moved into, hung close to Larry, got to know about all these, know what you don't know and what he means, and kept asking him about it. And, that's how I moved up. So I grabbed my opportunities. But again, it's not a Russian thing per se. It's just, I call it the immigrant, the immigrant drive. I got to go get it. Otherwise it's not going to come to me.
My great-grandfather came from Lithuania in the early 1900s, and they were in coal mines in Scranton, and his kids became doctors and engineers. So it happens quick when they got the drive, huh?
I was really, at the end of the day, when I look back, just trend following. Washing dishes obviously wasn't going to make me money, so I had to cut the loss there, right? I did work for 1 year out of school in an engineering role. I worked for RCA on high-definition television because I had a degree in electrical engineering. It was not losing me money per se, so it's not technically a losing trade, but it was just not going to take me anywhere, so I had to cut my quote-unquote losses there. So, I just trend followed my way into this. Trend following is just a good general philosophy of life, right? It's not just on markets. It's how people live anyway. This is why trend following in the markets works, because that's how people are.
I want to talk about getting some meatier issues. So when people look at trend following performance across the many managers out there, and we don't have to name names, people can go look at the performance. It's all freely available. I know often I can see up and down months where you can see, okay, trend following traders had a good month. You might see double the return for one particular trader versus another, but still, it's pretty easy to see that there's dispersion amongst trend following CTAs, trend following managers. Why don't you talk about the idea of that dispersion?
Yeah, it's by analogy to equities, it's actually very simple. Initially, this is complicated. This is why, actually, a reason why a lot of sophisticated investors, like the institutions you asked me about, have a hard time getting in because they feel like they might make dumb decisions about the space and end up picking the so-called wrong manager, the wrong trend follower, because they have no understanding of what causes differences in performance, and they get a little emotional. What makes one manager better than the other? Well, is it who made more money last year? Does that make them better? So they don't know how to step in. But actually, if you, just need to read 1 or 2 chapters in the book, it's actually not that complicated if you just make yourself aware there's a couple factors that drive performance. For example, in the late 90s in equities, by analogy to equities, the late 90s, so this is where, every internet stock went up 100% every day, and every brick and mortar stock stayed flat or went down, right? So you had this so-called dispersion between value and growth. Most investors understand that. That's why they'll have both in the portfolio. Sometimes you have dispersion between small cap and large cap. So if you make just a few, let's call them sub-classifications. So it's not just, okay, trend follower 1, trend follower 2, trend follower 3. Okay, those are the trend followers, but they have a particular focus. So if this was equity manager 1, 2, 3, the first one might have been growth focused, the second one might be value focused, the third might be small cap, fourth might be large cap. There's going to be some correlation between them because those guys are in the stock market, but there's going to be some fair degree of dispersion, and in a year like 1999 could have been 100% degree in dispersion. So now investors in long only say, okay, I go to my Morningstar little matrix, and then I need a little bit of value, a little bit of growth, so I kind of diversify. Same thing in the trend following space. You just kind of do a little bit of analysis and say, for example, the words are not the same, so it's not value growth. It's, for example, we introduce certain factors in the book like the speed of trading. So you could do trend following quite slow because either by choice or if you manage lots of money, maybe you have to be a little bit slower because of the size of your assets, or you can be a little bit faster. And you can get some different results and you can attribute them to the speed of trading. Okay. You can also have a market mix kind of bias. You could trade only kind of like the large markets, again, either by choice or because you're big, or you can be quite a bit more diversified. Like, for example, we are trading a lot of smaller markets. Well, sometimes those will cause performance differences. And so really, if you just track a few of these things, if you have to pick one trend follower, like the one, okay, you have to, I guess, interview them all and somehow pick the one. But if you would like to have a portfolio of 2 or 3 in kind of a diversified portfolio of trend followers, it's not that hard. Just look at a couple of these factors and who's tilted to slow and who's tilted to fast and these kinds of things. And you think that helps the audience. It's just by analogy to like the whole value growth thing. Just it's a little bit of effort, and then that can explain quite a bit of the dispersion between the managers. It's not just sort of random, because people are sometimes afraid, well, wait, you have 8 guys doing the same thing and you have like this massive difference in performance. I don't know, what is it? Some guy has a faster machine or bigger computers, and like they get scared because, whoa, they picked the wrong one. What is it? It's not that. They're doing conceptually the same thing, but they have certain portfolio tilts that can cause these differences, and with just a little bit of effort, one can understand them.
And speaking of a little bit of effort, and this is not a plug necessarily, but if people want to dig into even more of where you are going with all these issues, they're really going to have to pick up your book. And like I said, it's not a plug. I mean, for relatively speaking, for the price of admission, you just don't get that combination of words I mean, as a guy who's done some work in this arena, what you guys put together is substantial, to say the least. One last question, Alex. It's all the rage in the conversations, the media, Fed watching, discussion for the last bunch of months, rate hikes, interest rates going up. Now, I'm curious, because my first thought would be, and I think this has got some truth to it, we don't necessarily know what's going to happen if there's going to be a higher rate environment. We don't necessarily know how that's going to affect trend following. Give me your opinion. What's your thought process there?
We've looked at it over the 800-year data set, what happens in rising interest rate environments. But let's ask this question. You think equities might do well in that environment? I'm no prognosticator, but maybe it's possible that they won't, right? Will bonds do well in that environment? Well, almost certainly not, right? Because rates go up, then bonds have to go down. So I would put trend following as maybe one of the few things that might do well. But let's talk about this for a few seconds, right? Trend followers are agnostic to the direction. So if yields go up, so the prices go down, we will be short bonds. Now, it hasn't happened for many years that there have been substantial hikes in the markets. But if you look at the data, we have data on interest rates from 1395. Venice issued bonds in 1395 called Venetian bonds. So we have centuries and centuries of data, plenty of rising rates environments. And I'll just simply say we will make money being short bonds if that happens. Now, people ask technical questions. If you short bonds, you short carry, will that hurt you? I mean, the chapter explains on that explains what that is. It's not really going to hurt us. There's going to be almost certainly inflationary pressure somewhere, so we probably make money off commodities. There'll be, some interest we get on cash, as it's a technicality, but most trend followers put up T-bills as margin, so we'll make more money on margin. We'll make more money on something called a roll yield in commodities because we have to roll futures contracts. When you put all this together, it should be pretty good. At least we have a pretty good chance of making money, a better chance of making money in a rising rate environment than a fixed income portfolio. Let's put it that way, And meanwhile, look, some macro funds out there, not naming names, have been betting on a rising rate environment for how long? I don't know. Let's say a lot of this year, and they've been losing money on that. So look at the perils of timing. Of course, at some point rates will go up, right? It has to be a truism, maybe in our next life or something, but at some point they have to go up. But look at Japan. I mean, where's a law that says 10-year rates in U.S. can't go down more? I don't know. Meanwhile, we're making quite a bit of money on the trend that's in front of us now. When it turns, there'll be a little bit of pain when it turns, and then we'll make money the other way. This is the perils of timing, because you could sit there frozen like a deer in headlights, avoiding, ignoring what's going on now, not making money out of it, betting on a rate hike. When is it going to happen? I mean, yesterday already the Fed made some announcement, and now the market thinks it's going to happen later. I mean, nobody knows how to time those things, so just let a trend following system time it. And meanwhile, let's take the money, put in our pocket from rates going down. What's wrong with that?
I think what's so fun about this conversation is that it's been very plain talk. I think you've explained these issues just really nice, where people can walk away and say, wow, I wrapped my arms around that in a much better way than perhaps I did before listening. But then if they want to know the depth, getting back to the original idea of when Larry would introduce you to these simple concepts and then you found out the depth, you and Catherine have put that depth in a text. And I'm curious, I don't know if you know off the top of your head, how many words are in your book?
Not sure. It's 400 pages. Now, I would suggest for your readers, first of all, don't try to read front to back, all at once. There is I'm not plugging for Amazon or Wiley, but the Kindle version is, well, A, it's a little cheaper, but B, it's actually in color. So just to let your audience know, it's because the book is, quite thick. It has a lot of graphs and charts. And I noticed the version that's on the internet, on the Kindle in color, online, is in color, and it just might make an easier read. But, it's a lot of words, a lot of topics. but it's actually not that, it's not that complicated. If you skip a few formulas.
It's got a little depth to it, Alex.
Yeah, for people who need it, But again, for a lot of people would just say, look, and I've had conversations with prospective investors from simple to very, very sophisticated. At the end of the day, if you look at it simply, you just include an investment to this because, like I said, it's uncorrelated and diversifying. If you want to know about the theory of adaptive markets and all that, then, you have that chapter. So far, we have quite good feedback on it. It's not a how-to guide. One thing I'll tell the audience, they read that book, they're not going to have some magic solution that they can start a trend following fund and compete with us. It's not about that. It's about understanding trend following and being a smarter investor in trend following strategies, understanding things like dispersion and benchmarking and what we talked about. One of the reasons we did this is just to bring some academic rigor to what's actually a fairly large industry. I mean, CTAs have a couple $100 billion, and have never had this kind of sort of like rigorous evaluation that will help institutions. I think this will get more institutions. We just had a big consultant that put CTAs on the list of approved investments, and they hadn't done it for 100 years. One of the really, 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 really big consultants who consults to really, really big institutions, because of this kind of academic work, allows them now to be a smarter investor. They know how to benchmark. They know how to explain differences in performance. So now they can put this in front of investment committees and answer questions about that. Before, it was just a voodoo thing. Here's somebody's track record. Okay, so what? So, little by little, this will get, shelf space, and it'll get into people's portfolios and
intellectual shelf space, because there's no more bookstores out there, unfortunately. So, I've seen them in Singapore, though. The bookstores in Singapore were really, really packed when I was there recently. So it's
a real bookstore.
Yeah. They're packed. I mean, all the current best-selling titles in America. So I don't know if it's going to go by the way.
Well, help me get this book on that list.
Well, I think it's. I don't know anything about Singapore bookstores. I did have a book that appeared on their bestsellers list a few years back, but I'll see if I can dig up some info for you that can perhaps help. Wiley, for one thing, we'll just get on Wiley and say, hey, guys, we want this baby, because they love that kind of detail. I mean, it's the only place in the world where a taxi driver has ever recognized me. And let's face it, I'm not exactly writing about, topics that are, James Altucher or more famous people. I mean, a taxi driver recognizing a guy that writes a book about trend following? Come on. So yeah, I'd get on Wiley about getting in those Singapore bookshops.
Okay.
That's my pitch. Okay, Alex, people can go to isam.com, and I think there are some papers that that everybody can take a peek at if they go to the site.
I think so, yeah. Or find me through Columbia. We do, as a business, a high degree of education. This is how the book actually came about. We had been writing white papers for a while. We have a white paper coming out actually this week on an interesting topic. Maybe it'll be the first chapter of the next book. So continuing the education. There's a big thing right now, just to ask myself and answer a question quickly. There's a lot of mutual funds forming, sort of liquid alternatives, a lot of so-called cheaper versions of trend following being offered. I want to educate people on, what you get for what you pay for, and be careful about those things. But you will have now you have mutual funds that you can buy that do trend following. So the access points will be easier for people. They just need to be able to evaluate what they're getting. But it's going to become, the train is out of the station. It will become more mainstream.
Let's leave it there, Alex. Great conversation. I appreciate you coming on today. And like I said, everybody can go to Amazon, Trend Following with Managed Futures, Alex Greyserman, Catherine Kaminsky. Easy to find, easy to buy. Hopefully we can talk again in the future, Alex. I'm going to have to get Larry on for a really long conversation too. Alex, it was great talking, and hopefully we can talk again in the future.
Thanks, Mike. Bye.
Take care. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.